Mark, are they looking vulnerable?
I would say volatile, but not vulnerable. We think that over the next 6-month period, equities can still go higher because we expect that earnings growth is going to start to come through now, and that's what investors will focus on again.
Okay, but when does that change? Are we expecting, I guess if you look at U.S. stocks, we're late cycle in a couple of years. I don't know whether it's 2020 that we need to be a little bit more cautious about the outlook, because also the Fed policy will really start biting if the economy's not strong enough.
Well, I think that's right. As we anniversary the tax cuts in 2019 and some of the fiscal stimulus starts to wear off, that's when it gets much harder to see how earnings growth alone can fight off a recession, and then we'll have to see what happens. But I think over the next 6 months, that earnings growth is still going to be strong.
What's your take on treasuries? Is it like a treasury bet, or is it a dollar bet that if you get dollar right or treasury right, you kind of have a good quarter?
Well, we think that treasuries have had most of their run-up. We're not in this camp that it's going to keep running away from here. And I think, you know, the focus has to be on both. What is going on with real rates, which we think, if you saw what happened last week, when the equity market started to sell off, then that 10-year started to come off too, and so it still acted as a stabilizer in portfolios. So I think one of the things that investors are really grappling with right now is just how much these tariffs that have come on are going to start to show up in corporate earnings. And that's why any comments that companies are seeing slowdowns in their forward guidance will be something the markets could react to.
So, Mark, why do you think actually that Treasury yields are capped? And let me bring you over to my chart, which is, you know, looking at some of the Treasury kind of movement weighing on equities.
Well, I think there's a couple things. First, we haven't seen the inflation come in yet very strongly. That's number one. Second, if you look at the rate differential to the United States, many other places have much lower yields. And so the way that we're positioned here is to be overweight in the U.S. 10-year and underweight in the Japanese 10-year, so that if global inflation starts to come through, we've got a little bit of a hedge.